What's up, guys? I'm making this short video just to talk a little bit about what I've seen in the Christmas challenge, what it's been looking like so far, my thoughts and inputs. So you can take this as some help or just some things that I'm noticing, or you can just ignore it and keep doing what you want to do because your plan works for you. But this is just what I've been noticing from everybody trading throughout the week. And let me first say that I've really enjoyed it. I think it's helped you guys grow a lot, especially in the realm that you're trading in. You're seeing the different difficulties together. You're seeing wins together. You're seeing what works, what doesn't, and it's only been week one. So I applaud you guys on that. You've been doing a great job. So first thing I want to talk about is the good things. Collaboration has been key. You guys have been crushing that. Been talking to each other, working with each other, and just sending each other's charts and seeing trades together, comparing levels, things like that. The more you do that, the more effective your trades are going to be. If you have three people agreeing with you on a trade idea and you have the same levels, you have the same outlook on the trade, that's probably going to be the one you'd want to take. And I've noticed that the swing trade team has been doing that a lot. They've been making sure that a few of them agree on a setup before they actually take it, and I think that has been serving them very well. And I think it's pretty good because you guys all bring something different to the table. Like we've all learned, came from different things. We like different things, and are bringing those all to the table. And you guys are crushing it by showing each other what you guys know and helping each other grow. Okay, so taking trades that have real setups. You guys all seem like you have some indicators or things you like to look for on a chart before you take a trade. And a lot of you guys articulate it clearly. It would definitely help if you guys would post the reasoning for your setup on or in your chat, so that could help the other traders see what you're looking at and your teammates see what you're looking at, so they could possibly put some input for it. But you guys have been taking trades that have setups, which most people have. I don't want to say everybody, but a lot of people have been taking trades that actually have setups that I've seen is like, okay, that makes sense. I understand why they're taking that. A lot of you guys are focusing on support and resistance levels, which I think is helping you guys as well. I've seen that help you guys a lot, but mainly the collaboration thing. You guys have been crushing it in that area, and I think it's helping you guys grow. Correct me if I'm wrong, but I've seen some good growth out of you guys. It's really cool to watch and see. So bad things. These are the things that you probably came to the video for, not for me just to praise you and talk about the things that you did right, but I wanted to include some of the things you guys are doing well on that I'm seeing from a bird's eye view, right? And so these are the things that I think could be worked upon. I think some trades are taking way too big of a loss. The only thing you guys can manage in this market and in options trading is the amount of money that you lose. So I think this needs to be the number one priority, because that's the only thing you can control. You can't control the charts. You can't control how much money you make. You can't control any of that. You can only control how much money you lose. And that's because you're the one that decides when to get out of a trade. You don't have to let it go to zero. You can let it go 5%, 10% down, 20% down, and you can get out of the contract and manage your losses effectively, keep them small. But I've also noticed some people keep their stop losses too tight. You don't get a very good entry. You need to have a looser stop loss. If you notice you don't have a good entry on the lower time frames, you're probably going to have a wider stop loss. If you are looking at the bigger time frames and see a bigger move coming, and you just enter off a larger time frame like the 1 hour chart, you're going to have a little bit wider of a stop loss for your trade. If you're entering closer on the 15-minute or 5-minute, that would give you a little better entry and your stop loss can be tighter. But that means you're going to have to manage your trade more effectively and being more effective at looking at the bigger picture and then going down to the 5-minute, 15-minute to get your entry. You guys know I always say find multiple time frames that agree with your trade, and that gives you the green light to go, right? Personally, I like to look at these time frames right up here, the weekly, daily, 4 hour, 1 hour, 15-minute. And I like to have 3 of these timeframes agree with my trade idea before I enter the trade. And I found that to be very effective for me. Okay, so that's number one. You start using a hard stop. Look at the premium charts. I've posted videos on this numerous times. Go look at the premium charts and find where your stop loss should be, whether it's based on a certain candle that's on the actual stock chart, or looking at support and resistance levels on the premium chart. Okay. And if you don't know what I'm talking about, go look at the webinar recordings tab. There's a full video on premium charts. When I say premium charts, I'm talking about options contract charts, things you are actually buying and purchasing with your money to trade in the stock market. You want to know how those move. You want to know where those could possibly go. I like to use them for price targets. I like to use them for stop losses, and so on and so forth. If that's too far for you, just make it simple. 15% stop loss, especially on day trades, 20% stop loss, whatever you like, whatever you find effective for you. But when you get over that 30% mark, it starts to get harder and harder to recoup your gains, right? Smaller losses, you can take more of them, and you can have more opportunity for bigger trades. When the bigger trades hit, your losses don't really matter. So the point is, only thing you can control is the money that you lose, right? Okay, another thing I noticed was you guys were thriving in the trending market when we were having these couple days here, and then it started to get a little more difficult for you on these days, right? So what would I suggest? Zoom out and look at the bigger time frames. Take a look at the bigger time frames of what's happening. Okay, you could see we're obviously at a strong demand, so naturally you'd lean bullish. But now that we're looking here, it's starting to look pretty bearish, right? So when in doubt, zoom out. I've heard that plenty of times. Try doing that sometime. So when you see chop, avoid trading, or wait till the end of the day for a swing because you see something on the daily time frame that you like. Okay, so that could be a way about going about it. Next, give the trade enough room to breathe. So you have to have a happy medium, keeping your losses small and keeping your winners big. A way that can help this is if you go down to the lower time frames for your entry. So like how I prefer to find a trade is I'm looking at the daily time frame. I like what I see on the daily time frame. So I find it near a key level, turning point. Then I go down to the 15-minute and 1 hour and try to find a good entry, where that by doing this, going on the lower time frame and entering on a lower time frame will help me keep my losers smaller, because I have a more pinpointed entry and it should be near my stop loss. I also have a bigger reward percentage. So like return on the investment. My percentage of my trade is going to be much higher if I get in at a more effective time on the 15-minute than someone that sees the trade by the end of the day, right? Or sees it on the 4 hour, or waits for the 2 hour candle close, whatever. If I'm looking at the lower time frame, it gives me a better risk to reward, and gives me a higher win percentage when I win, right? And helps me keep my losers smaller. It's all about risk reward. That's all it does. It helps my risk reward out, which is what is the most important thing when it comes to trading, managing your money and risk to reward. So I'm talking really fast. Those are all the things that I've noticed, right? Not looking at the bigger picture context. Okay, so I'm just going to give an example of this one. So this means looking at the bigger picture, larger time frames, the 4 hour, daily, weekly. You're not looking at those before you take these trades. Like, is the risk reward even worth taking a trade? Like when we're up here, when we've had a run like this, and we're up here and struggling to make higher highs, would it be smart to take calls up here? No, because we're starting to get into where it's a little too overextended to want to be in the trade, right? And so this would be more of an opportune time to take puts. So, and somewhere down here, when we've had a large sell-off, you're going to be more inclined to look for calls and looking at the bigger picture if you're going to day trade something, right? So a prime example that I'm talking about is, like, basically what I'm trying to say is you want to like the trade on the bigger time frames before you just take it on the smaller time frames. The idea comes from the bigger time frames and the execution comes from the lower time frames, right? Theory is based on bigger time frames. Execution is based on the smaller time frames. I get my levels, I get my trade ideas, and I find that these traders or trades end up being much bigger winners when they're based on daily time frame ideas. Okay. So an example that I want to talk about that a lot of people traded this week, right? Apple. It's a whole lot of lines. Okay. Clear this off. We're going to go here. I'm going to find my trade. I'm going to find some levels, right? So we have a level here, turning point, right? Where's another turning point? Right there, that level there. I'm just looking for places on the chart where there's significant turns. Here. And I would call that probably good, right? Okay. So, oops, let me clear that off. Okay, anyways. So what I'm trying to get at is, do you see how right here we're at a pretty clear support level? Like we had a strong rejection here. We had a bounce here where we had a big move. It's almost, you could call it a zone, right? A zone of support that we are at for Apple. Now, this is just something where it's the bigger time frames that I want to talk about. When we're down here, and okay, I think both teams took puts on this rejection here on this daily candle, which is a good trade, right? It's a lower low or a lower high, and it has a nice daily candle that looks like a strong rejection. Okay. So a lot of people take puts. This was a good trade idea. It looked good on the daily time frame. The longer time frames, we had like this little demand here where we were continuing to reject, and we were kind of trading in this range. We rejected a key level from right here. And that's why this was a good trade, right? What was a trade that I saw some people take before that I didn't necessarily agree with, just because of where the daily time frame is. So some people took puts on the break of this level. Do you see the sell-off? Whenever you see a sell-off that looks controlled, you never want to trust it, right? Because see how this looks controlled and it's creating a trend? That's the sell-off is being controlled. Same thing here. The sell-off, this sell-off is being controlled. So I'm more inclined when it comes to the support to look for calls because we are having a controlled sell-off. When you see this sell-off happen here and you see it break support, you don't want to take calls here until it proves to break, retest, and then continue down, right? And you also need to be in sync with the overall market. Their overall market, SPX, is at a significant zone of support. Like this is a clear support that we have bounced off of in the past few weeks in this range numerous times. So this would not be the best place when Apple is at support. Sure, it may dip below it, but based on the daily time frame, we can see it's another controlled sell-off. Okay. Like see how this is kind of controlled. Now, if we clearly break below this level and retest it, then this will be an opportunity to take puts. But when you're looking at SPX being at support, you're looking at Apple being at support, being the biggest holding, you wouldn't want to jump into puts. Okay. So that's when you're looking to take a trade for a bigger move, everybody wants to catch the big move. So trade based on those bigger time frames. Like Walmart, you guys had a great trade. I think both teams took this as well. This was a great trade because look, we go the weekly time frame. We have this little evening star, whatever you want to call it, at a demand zone. Like this was, or a supply zone, right? And then you go to the lower time frame, which is the daily, which is still considered a bigger time frame. We broke this series of higher highs and higher lows when we broke this here. And this was a great move to the downside because it looked good here. It became a big winner. Okay. Now that's my point of looking at the bigger time frames. Too many people are trying to enter off of, I'm going to go over this one quick and the rest ones. Too many people are looking at like the 2-minute time frame. I don't even look at the 2-minute time frame. The lowest I look at is maybe the 5-minute, mainly the 15-minute to take my entries for trades. And that's just for entries. My trade ideas don't come from the 15-minute. My trade ideas come from the 4-hour, the daily, the weekly, sometimes the 1 hour. My bigger time frames is where I take my trade ideas. That's where I get in, and my 1 hour and 15-minute give me a good combo of when to enter. Like I'll usually see something bearish on the hourly, and then I'll go to the 15-minute for my entry when I see something bearish there. Okay. So you're looking at 2 small time frames. Zoom out. It may take some more time, but your account will thank you. Okay. So not paying attention to the risk to reward. Okay. So this goes back to Apple. When you're looking at this play, what has the better potential risk to reward? We can draw it out here. So here's a long position, right? We have this trend line that could continue to break out. So if we're here, this would be our stop loss, right? We would enter at support on the lower time frames. It would probably be just above. And then that's our risk to reward. 6.4. Okay. So let's go to the other time frames. Let's say I take puts here. I'm going to look for a trade here. And the stop loss is going to be above that zone. And say I get pretty close. It's a decent risk to reward, but it's not better than this one, especially when we see a controlled sell-off. A lot of times people are trying to take puts when we're already down so much. Like, for example, right now would not be the time to look at Tesla for puts. We're at a clear support. We're obviously not going to want to take that. So you're going to be looking bullish on Tesla. We want to see more. We don't want to catch it at the tail end of the move. Basically a FOMO entry. Okay. Next thing, too much attention on indicators. Too many people are just paying attention, looking at indicators and not paying attention to actual price action, looking at the volume, looking at the price action of the actual candles. Too many people try to base their trade theories off of the indicators. Indicators are a secondary confluence. Price action is the first confluence. So meaning like, price needs to be your leading indicator of when you're going to take trades and how you're going to take trades. Candlesticks, support and resistance, how it reacts to support and resistance. That's how you're going to take your trades based off of those things. You're not going to take trades based off an indicator. That's a secondary confluence. If everybody was taking based off indicators, everybody would be rich in the stock market, right? So why would I be taking trades based off of something that anybody can see? It can be an added confluence, like I could see a squeeze on this indicator, right? Or a MACD cross, but I'm not going to take a trade solely because of MACD cross. I need to see price action show me that it's going to react in the way that I'm thinking it's going to react. I need to see price action, support and resistance agree with my trade thesis and how candles are reacting to it. When I say price action, I'm talking about candlesticks. Okay. So don't cloud your charts with indicators. Pay attention to the actual price and how it's reacting. Every indicator is a lagging indicator. It's telling you what happened in the past and is lagging. Price action is the closest thing to a non-lagging indicator when it comes to the market. The only thing that's not lagging is tape, where you're seeing the time and sales of every single transaction within the whatever stock you're looking at. So that's all I got to say. I know it was a lot. There's an overview of all these things, right? And like I said, take it or leave it, trade how you want. But these are the things I'm noticing that I would correct in my own trading and also be proud of, right? All right. Nice job on the first week. And I will see you guys in a couple days I'll see you for the webinar tomorrow and the market on Monday. Don't expect much this week just because Fed meeting, CPI coming out. So we just got to be patient. All right. Thank you guys.